Accounting conservatism, definition, advantages and disadvantages explained. Have you ever noticed how businesses sometimes prepare for the worst before it even happens? In accounting, there's actually a formal principle built around that mindset, and it's called accounting conservatism. Accounting conservatism is the practice of being cautious when recording financial information. In simple terms, it means accountants recognize potential losses early, but they do not recognize potential gains until they are certain. Think of it like this: expect the bad news quickly, but wait before celebrating good news. Let's break that down. I should take notes of this actually. It would help me. Let's break this down. Imagine a company is owed money by a customer, but there's a chance that the customer may not pay under accounting conservatism. The accountant may hold a possible bad debt expense now, even before the loss fully happens. But if the company expects a future profit from a deal that isn't final yet, it usually won't record that profit until the money is much more certain. More the the goal is simple: avoid overstating how healthy the business really is. Why does this matter? Well, because investors, lenders, and managers rely on financial statements to make decisions. If profits are shown too high or assets look too valuable, people may think the company is stronger than that it actually is. Accounting conservatism helps create a safety cushion by making reports much more cautious and less overly optimistic. Now let's look at advantages. The first big advantage is reliability. Conservative accounts reduce the chance of misleading people with limited profits. The second, it protects against uncertainty. Businesses face risks all the time, and this principle helps prepare for possible losses early. Third, it builds trust with investors and lenders because the numbers are less likely to be exaggerated. But it's not perfect. One disadvantage is that it can make a company look weaker than it actually is. If losses are recognized early and gains are delayed, profits may appear lower than the true economic picture. Another issue is that too much conservatism can hide potential growth. Growth potential, making it harder for outsiders to judge performance accurately. So while it creates caution, it can create an understatement. A common misunderstanding is thinking conservatism means accountants should always make the businesses look bad. That's not true. Purpose is not pessimism, it's prudence. Another misconception is that the rule eliminates all risk. It doesn't. It simply makes financial reporting more careful when uncertainty exists. So, what's the key takeaway? Well, I'll tell you. Accounting conservatism is the principle of recording possible losses sooner and possible gains later. It helps keep financial statements cautious, realistic, and less misleading. But if used too heavily, it can also make a business appear weaker than it is. And once you understand this principle, you'll start to see why in accounting being careful is considered smarter than being overly optimistic. Thank you for watching. Have a good day. Check out the other videos. You might find it useful.